All right, thanks guys for joining us. This is an option workshop on broken wing butterflies. Yes, we did do one just last week. That was on the calls. This is going to be on the puts. One thing I strongly recommend is when we send this out to you guys, watch it again because it will make the nuances of this strategy really stick in. Another thing is I don't necessarily teach it like everybody else. So the way that I've designed this strategy is to increase your probabilities of success. So follow the rules that I have with this, and it should increase your probability of success going forward. I do have to get over a couple of things. One thing, I want to introduce myself. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree and decided, you know what, I want to switch it over to finance. And then upon graduating college with a finance degree, I decided I was going to pack it up and move to Chicago to work on the floor of the Board of Trade. So I started out as a runner and moved myself up into the pits and continued trading there. So in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all of these products in all market conditions. I've been trading on the screen for probably about close to 10 years now. I mean, I was even on the floor and still trading on the screen. I was kind of doing both, actually. I do have to go over this disclaimer, and please make sure you guys understand this fully. It's basically any opinions, news, research, or analysis, or other material provided by Pro Trader Strategies and companies or employees is to be provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, you guys, we're here to teach you how to swim, not to swim for you. I can't give you investment advice. I can't tell you that a strategy or an underlying that I am trading is right for you. That is up to you guys to dig into your soul searching, figure out if it is a risk you are willing to take. And the bottom line is, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. How did I get that close to the cup in the picture? They brought it down to the Board of Trade and opened it up. So we got, every time they won the cup, they brought it down to the floor, and we got to get our picture taken with it. Another thing, follow us on Twitter. You can follow me in particular at Wolfman's blog, and you can follow us at Pro Trader Strategies, or Pro Trader Strat. That's the parent company. So you can follow us there. They throw out good wisdom, and hopefully I do too. Usually might get more snark from me. Like I mentioned, this is on the broken wing put butterfly, and the beauty in this is that it has no risk to the upside. Just like the call butterfly, the broken wing call butterfly, it's a little counterintuitive, where this, our limit is, or we've limited our risk to the upside, and we're going to be trying to design this strategy so that there is no risk to the upside. It's only profit. So to the downside, we will be increasing our risk a little bit, and I'll show you how that all works. But at the end of the day, anytime you limit your risk, you're increasing your risk somewhere else. And another thing with this is a higher probability trade. So anytime you increase your probabilities, you also increase your risk. So from my standpoint, I like to take on the risk in order to increase my probabilities of success. So keep that in mind when we're looking at this strategy. This has a higher risk parameter than you would have with just the broken wing butterfly, or with the regular put butterfly. It's not Photoshop, the cup. Nope, that was the real cup, and I stopped short to save my lips, I guess. anyway, this is also known as a skip strike butterfly or a wounded wing butterfly. Actually, we got a great question. The sound should be on. Is anybody else having a problem with sound? Because Ken seems to be having problem. Everybody else is having, okay, it's okay, yeah. So it's a wounded wing butterfly, and as a matter of fact, I got an email from one of you guys, and it was a great question, and he was asking, is this somewhat in relation to a ratio spread? Well, I think that you could consider this, in a sense, a ratio spread where you're, rather than having a naked put, then you would cover that. But that gets a little bit confusing to me. I like to look at it as this is a butterfly with a embedded short put spread in there. And then that embedded short put spread, or that synthetic embedded put spread in there, is what finances the other side of the wing. So I'm going to go into the details of that, but just kind of let yourself mull that over a little bit, and that's where that skip strike comes in, and that's where that embedded short put spread is. So I'll go into more detail when we pull up the platform and look at the Analyze tab and stuff like that. I'll be able to show you a little bit better for that. But just keep that in mind. This is also a market neutral strategy. Now, the way that I set it up, it really is kind of like a non-directional strategy in a sense, because the way I set it up, we are going to be slightly bearish, and that slightly bearishness will get us to our max profit potential. But if the market goes higher, then we will be able to keep that credit we receive. So there's no risk to the upside with this type of strategy. Now, we don't want this to have a big sell-off either. We just want it to maybe come down and pin to a certain strike location. Maybe we think that that's where resistance is, or that's where the market finds value, is the way that I look at it, using like the market profile and stuff like that. But at the end of the day, this is a situation where we don't really care if it slightly comes off a little bit, but we definitely do not want this to have the rug pulled out from under it and it falls off, because that's when we would receive our max loss. All right, so with the skip strike butterfly, or the broken wing butterfly as I like to call it, to set this up, we do need to have a market assumption, and we also need to have high implied volatility percent, above 50. Now, one caveat to this high implied volatility percent, that's for a regular stock. If we have something like an index or an ETF, then we could have this IV percent be as low as 30. The reason why is because when you have a basket of goods, that implied volatility doesn't really get that high. So a pretty high implied volatility percent for an index or an ETF is anything basically above 30. And we want to collect a credit for this, or do it for zero. I don't like to do it for zero, to be quite honest, because it doesn't really make it worth it to me to have zero risk to the upside, but I've increased my risk to the downside. That's another thing. I always look at it like I need to collect a credit, because if I'm going to increase my risk to the downside, I need to at least get some profit to the upside if it were to go that direction. So keep that in mind. I would never do this strategy as a debit, and there's a lot of times where you're setting this up, or you're thinking, well, you know what, I think it's going to go down just a little bit and pin to this strike, but I want to be careful of the upside and maybe even profit if this continues to move up. Well, don't do it for a debit, because for that reason, you're going to lose to the upside, and you're going to lose even more to the downside if it continues down a little bit past what your expectations were. So always trying to at least collect a credit for this strategy is the absolute goal in this. And it's not to do it for a zero credit, but worst case scenario, that's where you're kind of looking at. All right, so this is the setup for the broken wing butterfly. Basically, we're buying an in the money or an at the money put. Now, depending on your strike location is going to be more or less what your directionality is. I like to usually pick the one that is at the money, not necessarily the one that's in the money. It makes it a little bit more difficult, but sometimes when there's when the puts get pumped up, it's a little bit easier to set up with the broken wing put butterfly than it is with the call butterfly, because when implied volatility pumps up, there's a little bit of skew to the puts. As people are trying to protect themselves to the downside, they buy puts and inflate those prices a little bit. So it makes it a little bit easier to set this strategy up with the put butterfly. And you know, in most environments, not necessarily the environment we're in, but in most environments. So I usually like to go at the money, buy that put that is closest to where we're trading. And then when you're doing that, it gives me a little bit more room to the downside, because our max profit is going to be when the underlying trades down to these two out of the money puts that we're short. Then we're going to be buying and limiting our risk by skipping a strike and buying the out of the money put. Now, you guys, if you're familiar with just a regular butterfly, we would buy one at the money or in the money put, sell two out of the money puts, and they're equal distance to buying this one. What we're doing is, in a sense, if we were looking at, say, a regular 40, let's say the 40, 45, 50 put butterfly, right? What we're doing is we're selling the 40 puts and then buying the 35 puts. So that's where that embedded put spread comes in, because when we're selling those 40 puts, it negates that, right? Because a positive and negative negates that, and then we're buying it a little bit further down. So we're kind of equaling our distance a little bit further down. So that's where that embedded put spread is because a regular put spread would be a 45 or a 40, 45, 50 put butterfly. We sell those 40 puts, buy the 35 puts. Now we have the 35, 45, 50 put butterfly. So there's an embedded short put spread in there. No easy way to find high IV right now. And yes, correct, Pete, you are dead on. And I've been struggling for 3-4 days with this one, and even 3 or 4 days for the last one, trying to find some, just praying for somebody to have some implied volatility spike. We got it with Palmolive, Colgate Palmolive, but you know, their spreads are a little bit, or their bid offer is a little bit wider than what I'm comfortable with. So it really wasn't working out, despite the fact that it's at its 52-week high in implied volatility. So it's not always easy to find a setup for this strategy, but when you do, it's a great strategy to put on. It's not one of the easiest ones to find a good placing for, but when it works out, it's a really nice payoff, or trade-off, I should say. Can you show us when you go to the chart? Yes, I will, Trevor. ER, glad to have you back. All right, so just keep in mind, we're skipping that strike on the downside. All right, so let's go through our rules, the way to set this up, picking the right underlying. I always say this at the beginning. One of the most important things you can do is find those underlyings that have a tight bid ask. And one of the rules of thumbs I go with for picking the right underlying is if a stock is $100 or less, we want the bid offer on any one of those strikes that are just out of the money to be about less than a dime wide. The tighter, the better, because especially with this strategy, we're talking about 4 legs being the one we buy, the 2 we sell, and the other one we buy. That's 4 legs where the wider that bid ask is, the more wiggle room and more edge you're going to have to give up on all sides. And that will eat into your profit. The longer you do that, you know, those pennies will definitely add up. So you're going to have to give up a lot to get in and give up a lot to get out. And that's eating into your yield. So one of the few things we can do when we're trading options is order entry and managing order entry. That increases our probability of success. And one of the easiest way to do that is to pick an underlying that has a lot of volume and open interest. One other thing with this is a stock that's like a $300 stock. I usually just move the decimal point 3 ticks to the left. So if it's a $300 stock, you move that tick 3 ticks to the left, and the bid ask should be within 30 cents. So when you're talking about higher stocks, then that's kind of your ballpark on thinking. If I'm trading a $300 stock, that bid ask needs to be inside of about 30 cents. And this strategy is a little bit easier to set up with the higher price stocks. So that being said, make sure that there's tight bid ask, because otherwise it could get a little wanky. And picking the right strikes. Now, this is all based on your directional assumption. If you think it's going to stay right here, then you're going to be looking at buying that in the money call and then selling two that are just slightly out of the money to start. I usually set this strategy up with the at the monies, or the ones that are just slightly out of the money for the most part, and set it up so it gives me some room to the downside to be right. And then if it does rally, then I get to keep that credit. So that's how I kind of play it. This is also a play on Vega. So Vega being that when volatility is high, we want that contraction of volatility so that we can take advantage of that. So we can get out of this strategy sooner than later, because this is a strategy when you're playing around with those strikes that are very close to at the money or in the money, they decay a lot slower than the ones that are further away. So it's a play on Vega, and if you have high Vega, high volatility, or high implied volatility percent, that when it contracts will allow us to get out much sooner. James D, would it make sense to put this type of trade on for at least enough credit to more than compensate for the commissions? That way you truly don't have any upside risk. James, absolutely. I guess one of the downstrokes for me, I guess, being on the floor and stuff like that for so many years, I have a tendency to look past commissions. It's one of those things I just don't always look at. So yes, that would help ensure that you don't have any risk to the upside, but I don't always take that into consideration. It's not like one of the things that is going to be the major concern for the most part. But yes, definitely it is wise to keep track of your commissions for the most part. Now, picking the right duration, because I mentioned that this is a low probability trade, right? We don't really necessarily have to pin the number or nail the number like we do with a regular butterfly. But having said that, it being a lower probability trade, the longer we have this trade on, the less probability of success we have. So you guys know that usually when I'm talking about selling strategies, maybe the Iron Condor or something like that, I'm talking about entering it out here. I like to get inside of this 35 days, somewhere between 35 and 28 days. So we're kind of right on the edge of that right now. So this is a good location to get in there, because not only are we trying to take advantage of contraction in Vega, we're also trying to exploit the theta decay here, because we want those options to decay rather quickly. And if we're out here, they're just not going to decay very quickly. We're going to be in that strategy for a longer period of time before we start meeting our profit potential or our profit target. So this will allow us to get into this trade a little bit sooner. One thing I don't like to do is stay in these strategies for inside of these 7 days. You're going to be possibly risking assignment risk and things of that nature the closer you get in here. So definitely want to try and get out before that, just because once you get assignment on these, that starts becoming a pain. And as James mentioned, you know, you're going to have a lot, your commission costs are going to go through the roof because you're going to have assignments and all this other stuff. So we want to try and stay away from that. Could I arrange for you guys to get the market maker trade cost? Fed, is that for like, are you talking about go over the market maker move for earnings that I kind of mentioned in the last week's? All right, so well, one thing is, you know, so it's a play on Vega and we're trying to exploit Vega. Play on Vega and exploit theta at the same time. All right, now picking the right environment. Obviously, we want high implied volatility in this also. So as I mentioned before a couple of times, because the reason why we want that high volatility is because we'll have to pay less for this, or not necessarily pay less for this strategy. We'll be able to get our wings further away from where the current underlying is trading. And if we can get further away, it kind of stretches out that peak that we're going to be seeing in the Analyze tab, and it'll allow us more room for error. If there's less volatility, that peak gets really steep and starts looking like the Washington Monument, and we'd much rather have it stretched out and looking more like maybe the pyramids or something like that. So the further we can stretch out those wings, we want that slope to be less of an angle. All right, knowing our exit strategy before we enter into the trade. The reason why we have to know our exit strategy before entering the trade is so that we stay mechanical, so that we know our target before we ever implement this trade. Because if you don't know your target, you're going to have a tendency to maybe wait another day. It's really easy to say, you know what, I'm going to wait another day or two just to get a little bit more theta. This trade is working out pretty good. Keep in mind, stick with the program. If you every day you stay in there, your probabilities of success are decreasing because you've beaten the probabilities so far. That means probabilities are going to come back around and bite you. So stick to the program and know your exit strategy before entering the trade. And with this, what I'm usually looking is trying to risk one to make one in a sense. But if we are knowing what we have to know what our max profit potential is on this trade, and I'll show you what that is here in a minute. But if we get 50% of that max profit potential, that's when we're looking to close this out. And that is on the high end, you guys. So, you know, somewhere 35, 45% even of that max profit potential is where I'm going to be looking to get out. And the sooner I start reaching, if I go a week and a half, 2 weeks in this trade and I've gotten 40% of my max profit, I'm probably going to look to cover this strategy because, you know, we're starting to get closer to the expiration, things of that nature. And if it's kind of flatlined, there's a higher probability of this happen, of a big move happening. One other thing is, no, I don't put this trade on around earnings. This is just one of those that I don't. I like to do the iron condors and the strangles around earnings, or short call spreads, short put spreads, depending on my directional assumption. And I've gotten all kinds of webinars on those, so you guys can check those out too. Was gone for a minute, so maybe it was covered. Did you possibly pinning and determining the center strikes? Well, yes, Fred. I think okay, so let me read that again. Do you try to use possible pinning and determining the center strikes? And yes, that's going to come into play here. Unfortunately, we're not going to have a whole lot of examples to find that, but yes, and I'll show you on the market profile what I usually kind of look at for that. But let's go over a couple other things real quick. These are some of the differences between the traditional butterfly and a broken wing butterfly. Traditional butterfly, you got to nail that number, right? If it goes up or down very much at all, you are hitting your break even and or into the losing zone of this. But the beauty in it, is that you have much lower margin requirements. When you put that embedded short call spread in there, that's where that margin requirement really starts jacking up a little bit. So the transfer of risk from the upside to the downside, in a sense, is what's happening, and that's going to cause us, with the broken wing butterfly, that transfer of risk is going to have a higher potential of max loss, but we're protecting from any upward move, and we have a higher profit potential. Because think about this, with a regular traditional butterfly, if it moves up or it moves down, we're losing money. With this one, if it moves up, we make money. If it slightly moves down, we make money. But everything below that then becomes our risk. So you have a higher probability of profit because you have a little bit of leeway to the downside, and everything to the upside is scot-free. So that's where your higher profit potential becomes, because you have a higher probability of profit. So this is kind of a setup that I found with FXE, and you can see that right here is the zero where you start losing money, your break even here, and this is your max loss on this trade. Your max profit is risking one to make one, so you're risking $100 or $1 to make $1, and then there's no risk to the upside unless we were talking about James's example. Yes, the risk to the upside is that we're going to lose the commissions that we paid for this trade. So you could look at it like, yes, it's a $6 loser if we really rally up, because that's the cost of commissions here. But our max profit is $100, our max loss is $100, and they're going to take that loss. Now, this is where that embedded strike comes in, where I was talking about. A regular butterfly would be the 101, 102, 103. Well, what we did was sell the 101s, which negates that out, and buy the 100s. And that's where that skip strike comes in, and that's where that embedded put spread is. Okay? All right, so these are a couple other examples that are a little bit older, but you can see here, this is your traditional broken or traditional butterfly. You're paying a debit for it, so you have the risk to the upside, you have the risk to the downside, so you kind of got to nail the number in here. But when you break that wing, where we have this 18, 17, 16 fly here, when we break that wing, or put fly, I think I may have said put fly, if we break that wing, we have the, on this one, the 19, 18, 17, so we kind of skip that strike right there. We took out the 17, we skipped the strike there, and now we're able to do it for a credit. So the upside is above the zero line, so we have no risk to the upside. We did increase our risk to the downside in a sense, but there's no risk to the upside there. Like I mentioned, profit, max profit, we're looking at taking a max profit of 50% of what our overall max profit would be. What is that max profit? The max profit is the higher strike minus the middle strike plus the net credit we receive. So that's our max profit on this. So basically it's the small put spread plus the credit we received. Then our max loss is that skip strike, because remember with this, if you guys remember the conundrum I had on the last one, this is where I was coming up with the skip strike. The reason why you go skip strike minus the lower strike minus that net credit received, that's your max loss. The reason why we use that skip strike, because if the market was to go down and go through our lower strike, that's our max loss. Well, in the meantime, we have a long put spread that started out at the money. Remember, at the money, that put spread there is financing half of the downside in a sense. So that's where it's financing it all the way to where our skip strike is, in a sense. So we take our skip strike minus that lower strike and minus the net credit we received, and times 100, because when you're talking about pennies and options, you have to multiply everything by 100 to determine where your risk is there. And then our break even, we're only going to have one break even. Now, if you do this for a debit, which I highly suggest you do not do, you're going to have two break evens. But with this, we're going to be doing it for a credit, or not doing it in my eyes. So we take the skip strike minus the net credit we received. That's your break even. And the reason why we're subtracting out our net credit received, because remember, if we're getting a credit and our skip strike is, in my example, the 35, 45, 50 put broken wing butterfly, we take that 40 strike and subtract it because we got a credit for it. So that gives us a little bit of leeway to the downside. All right, so enough of the boring stuff. Let's pull up the platform and kind of get to it. This is usually where I kind of make this back and forth with you guys a little bit more so than even just asking questions, but throw out a couple of stocks that you guys usually like to look at. We'll kind of run over the rules of what I look for in that stock to see whether or not it will fit along the rules. Now, as you can see, we have basically even historical low volatility going on right now. This is the VIX, and you can see we're way down here. So it's pretty sad for this kind of strategy. But there are a few out there, and we might even just go with a couple of. So first one is Netflix. Seeing everybody's blowing it up. Love the participation. So Netflix. So 28 days, that's inside of our 35 days. This is about as low as we're going to be able to go with this strategy because of theta decay already happening. But the first thing I look to do is underlying's trading at 142. So we're looking at a 14-cent wide, because remember, I'm kind of looking at moving the decimal place 3 ticks, so 14, 15 cents wide. That puts us right in line here. That's pretty close to 14 cents wide. It's right on it. So that follows the rule. Netflix will even have a lot of times tighter markets than that. People are willing to give up the edge. They're kind of in the weeds. So the next thing I usually kind of do is go and flip and look at the chart. I haven't updated it in a while, but let's see. Let's go back to the year chart on this. You can use the Fibonacci levels, things of that nature. That's definitely possible. That's how you like to pick your location. I'm going to have to remove this drawing because it's old. So in a sense, it's kind of, it's following this trend line though quite nicely. So this would be a situation where we would worry about the upside, right? It hasn't broken below this trend line in quite some time. It's continuing to go up. I don't know exactly when their earnings are right now, but we can look at their IV percent is pretty low. It's 6%. So this is where I look at the current IV percent. I need that to be above 50. The reason why is because if I do this strategy, we're going to have to do it as, buying the 45, selling the 40s twice. And I usually do this as holding down the control button. So when I buy the 45s, if you don't hold down the control button, it disappears. So hold down the control button, hit it twice. Then we're going to skip this strike, right? This is the embedded. As a matter of fact, I'll just do it as a regular butterfly. We'd be paying $1.50 debit. So in a sense, what we're going to do is we're going to sell the 40 or the 35s. So we're selling those to negate that out. And then we're going to be buying the 30s. And we still have a debit. So that's one of those reasons, higher implied volatility will pump these up and allow you to get that credit. The other problem with this strategy right now is that, especially for Netflix, you only have about a $5 window, and Netflix will trade $5 in any given day. You can see the high and low here is $4. So that's another reason to kind of get that a little bit wider. All right. ER's got ABX. All right, so the gold bugs, let's look at, it just had earnings, so it's positive in a sense. If you're bullish gold for sure, you'd want this strategy on. So let's look at the trade window. Let's delete this one. And it's at its low end of the implied volatility. Look, I mean, as a matter of fact, it's just diving. So this one, you know, the problem with this is with volatility that low, the probabilities our volatility is going to come back the other way, revert back to the mean. So we don't want implied volatility expanding on us in this one. So let's skip over that one. The next one was IBM. Come on. IBM has really low implied volatility. You know, there's ways to also look at the implied volatility percent, because sometimes it'll get a little bit off. Like if we look at this particular platform with Altera, you can see they've got a 60 implied volatility percent. We'd think that that would be a candidate for this. They just had earnings, high implied volatility, but look at this spike down on here. So you'll get that. That's an anomaly. It's kind of like, look at it like, you know, the diving, when they do those, the diving competitions, right? They take out the high and they take out the low in a sense, because those could be anomalies or somebody being nefarious in a sense. Well, this is one of those situations where you would want to look at it, you see that massive spike and be like, all right, there's something wrong there, because this, where my cursor is generally where the lows happen, and we are very close to that low. So it's really probably closer to a, you know, a 5 or a 6% IV percent. The way to come up with this, to do this calculation on your own, the way that the system's set up to do it, is you take where the current IV is, which is 15, and you have a numerator and a denominator. So you take where the current IV is in the numerator and subtract it from the low, which is pretty much right here, let's say. So 14. Take the sum of those two numbers and divide it by the high, which, you know, we might be able to take that one out. The high being 24 minus the 14. So we have 1 divided by 10, right? So it's in about a 10%, 10 IV percent. Does that make sense on that? On the MO chart, is that real, or is that, I think it's a data error, but it makes for a good example. I think this is a data error, but it makes for a good example for sure. As a matter of fact, it's not showing up on my other platform. So I think that's just data. All right, so let's look at Micron. And Micron's, see, it's got that data error here again too. So Micron's saying a 39% IV, but I bet that that's not showing up on the other platforms either. So, but again, you know, same situation. We could do the math on that and realize that that's at the very low end of IV percent for that trade. So the other one was Priceline does have earnings. Yeah, I was actually playing around with that one today. I think we're going to have, for an example, don't do this. I mean, I would suggest highly to not do this around earnings, just because you don't have much risk to the down, or you have too much risk to the downside, not enough room in a sense. I guess if you could get far enough away where we can look at Priceline real quick, where it's going to maybe have the market maker move in there, but it's not. But Priceline has high implied volatility percent. It does have earnings coming up, and it's like within the next couple of days. So let's see. Let's look at unless you know offhand. So yeah, it's like on Tuesday or something, isn't it? Yeah, so the 27th, so 10 days away. So this is something we wouldn't do it on, but for example, I think we might be able to play around with it. So let's just go ahead and look at it anyway. It's got a 50 IV%. Let's pretend it doesn't have those earnings and a binary event embedded in it. So we're going to 28 days out. So this is something we probably could do a little bit more on this with. So we want to kind of protect ourselves to the downside, because I would be a little bit concerned whether we can look at the chart and say, for me, with the, it's been in a nice uptrend, but to me it's getting a little overextended to the most part. We have a doji there. So we'd probably want to get a little bit lower with this strategy. So depending on how bearish you are would be depending on how close to the at the monies you're going to want to do. And we could do this where we look at it, should be about $1.60 wide for this. It's a little bit wider than that, but price line, again, you can probably work it. So that's, again, when you have $1,000 stock, move it 1, 2, 3, it's $1.60 how wide these should be. We're looking at 5, so 620, slightly wider than that parameter there, but we'll look at it anyway. So we're going to look for a little bit of covering the downside. So we're going to start out with buying the 35s. You could probably even look to buy the 30s if you were even more bearish to the downside. So the 30s, we're going to probably be able to go $10, maybe even $20 wide. We'll look at it both ways. So we're getting a $34 credit. So we went $10 down. So now we need to go $20 further, which puts us at the 16s, and it's going to just give us a credit. So let's set it up right. We got $10 here, $20 there. So we kind of sold that 1610 put to buy the 1600 put, and we got a credit for it. Pretty nice, decent credit for it. So let's look at analyzing this one for price line. And as you can see here, it's pretty narrow, but let's look at the standard deviations on this for that, and then play around with it. So that's one standard deviation move. So obviously we don't have a ton of room to the downside, but if it continued to go up, I mean, right here is basically where we're trading right now. If it stayed here and went higher, we'd be able to collect that full credit. If it came off a little bit, this is where our max profit potential is on this trade. Make it a little bit more easy to figure out. So, our max profit potential on this is about $12.50, and to the downside, it's really only $600, and we can go through the math and figure it out. So this is a pretty good one. Like, we're risking one to make two in a sense on this. So you have to be willing to accept that kind of risk, but at the end of the day, that's a pretty good risk reward in a sense. It's not necessarily risking one to make one. So this one would probably be pretty interesting to put on. So if there wasn't an earnings event going on, I wouldn't necessarily want to do this for the earnings, because you can see on Priceline on their earnings, this was an earnings. It went from 1340 to opening up 100 plus higher. So on their earnings, they have a tendency to really get moving. So I would definitely not want to only have 30 ticks of love on this. But, you can see when they don't have earnings, it's relatively within reason for something like that. Does that make sense for everybody? So we want to be able to try and have our reward, our max profit potential, higher where it goes to that peak than what we are willing to lose with this one. So make sure you try and set it up that way, and don't ever do it where your max profit potential is, let's say $100, and your possibility of losing is $150. That doesn't make sense. You've given up too much on it. Just move on to a different trade. Find something else. How far back do you look for the IV? 6 months or a year? Good question. I usually look at the full year, but if you start, I'm not going to lie, in the last 6-8 months, I've been looking more and figuring out my own IV percent because IV is so low, and we had some real high IV within the last 52 weeks that I've kind of been playing around with that a little bit more lately. But be consistent with it. I try and stick to that 52 weeks rather than the six months, but be consistent. If you're always doing 6 months, always do 6 months. A great question. Where can you find the IV percent? That's a good question. So you basically, with toss, you go up in here and hit the gearbox, and should pull up a window. And oh, actually, it's not the gearbox. It's the sorry, I always confuse that. It's the beaker for some reason. And then you can just type it in here, IV percent or implied volatility, and it'll give you the implied volatility. It doesn't really give you necessarily the percent, but it'll tell you where the implied volatility is. Over here, it's the same thing. You hit the gear, or it's a little bit different. You hit the gearbox and do the same thing by typing into the thing and add it over. This is where you add anything to your chart for the most part that you want to keep on there, at least with this platform. The idea is to aim for a 50% and take it off, correct? Yes, correct. That is correct. So if we look at the Analyze tab, so for instance, this profit potential is 1250 on the upside, right? So what's our target for that? $625 if that happens. Otherwise, if it just kind of rallies up, I'm going to be more inclined to hold on to it a little bit longer. And I'm not going to take it into the last 7 days, but when it starts getting maybe 10 days in there, then I'll just I'll take it off for whatever I can, and it's probably going to be pretty cheap at that point because they're going to be pretty worthless on the other end. But if it's kind of starts hanging out down here and playing around back and forth, you pin this number for a little bit, and you can get out of it for $600+ then that's exactly where I'd be looking to get out. And then the downside loss, OS stop. So, depending on your risk parameters of where you want to get out with this strategy, especially with a risk reward like this, where you're risking 1 to make 2 in a sense, I'd probably let this risk run out because, if it came back up, I have a pretty high probability of profit on this one. So I usually let these play out. And it's very difficult to defend because if you remember, this is really a long butterfly with an embedded short put spread in there, or a long butterfly with an embedded put spread in there. But that being said, anytime you're doing long strategies, it's very difficult to defend because you have a tendency, if you're paying a debit for something, it's very hard to defend something like that easily. Credit spreads usually are easy to defend and manage that risk, but this one is a little bit difficult in the fact that you'd have to be breaking these short puts, and they're going to be deep in the money, so you're going to be increasing your risk by playing around with that. So I wouldn't even do that on something like there. All right, so that's a pretty good example if the earnings wasn't in there. So one of the other ones was I was even looking at Colgate. Like Colgate has 100% IV. Let me get out of there, go to the trade window, delete that. But Colgate, having that said, I mean, they had a big move today. just caused IV to continue to spike up. This one could consider as an anomaly, but on the upside, I'm going to take advantage of it. Just like if it was deep in the hole, that'd be where I'd probably be buying strategies on that one example where it was just through the floor. Through the roof, I mean, yes, there is a possibility that that implied volatility is going to increase, but the further away it gets, you know, the less traction it really has. It always wants to revert back to the mean. You know, it's just like a chart. You can see it any time. It's going to want to kind of pull back, and I would have to say that this is getting a little long in the tooth in a sense. So I would think that this one would have a good strategy that we could build around it. So to the upside, it kind of topped out up here around 93. So in that, I think the volatility would come back down. So I would say that if we can buy this one, and this is also a little bit wide. We went 7 cents wide in a sense, and we're well outside of that. We're double that. But just for an example, let's look at if it would work out. So we got $2.50 wide, so we need to go $5 wide on this. So I started out with the 2s, the 50s, so buying the, I had to set that up wrong. Let me do it again. So buying the 2.5s, selling 2 of the 70s. Like I said, you're holding down the control button. You can see it flash up here at the top when I hold down the control button to get ready to set it up. And I always build these out. Yeah, you can go in and set it up through the drop-down menu here and hit butterfly and then start playing around with the legs there, but I usually like to go with it this way. So we got $5 wide, $2 wide. It's a debit, so we'll just look at it on the, it wouldn't make the cut for me, but we can go in and look at it anyway just to show you what the Analyze tab is, because in the sense we have losses to both sides. We do not want that. Because why take extra risk to this side and still have risk to the upside with the strategy? It doesn't make sense to me. So if you're going to pay a debit for it, then I would just go ahead and look at the 7.5s, and you know, now your risk is much more limited to either side. That makes more sense to me. Oh wait, sorry, that's probably needs to be unlocked. So 80 cents to the downside, not 60. So you know, you've increased your risk a little bit, but see what I'm saying? So that's something I would just kick to the curb altogether, most likely. So I'd probably start looking at something like iron condors with this one if I really wanted to take advantage of that high implied volatility with Colgate Palmolive. With the downside stop loss, or when we get out, I usually will let this ride out because it's a high probability trade. You know, it could definitely go down there and test that other side. I'm just going to usually, with spreads like this, where I know my limited risk, I know where my risk is, then I'm not going to look to just pull a plug on it. But that's up to you. For me, I'm not really looking to do it. You know, at the end of the day, you could say, you know, you're probably not going to be at max loss right away down, you know, as soon as it gets to this point. Then you could look to cover that, or when it breaks through your break even, pull the plug. For me, I kind of let it play out a little bit because I kind of look at it like the probabilities are the probabilities. Does that make sense for everybody? Anybody have any more questions? Whoa. Somebody does. Do you have a presentation on how to set up TOS platforms specifically for your trading style and a video as to set up instructions so I can follow you better? Yes, absolutely, Chris. Great question. I do have a bunch of little videos out there for how to set up, like for, you know, you guys all see my whole thing with this. This is the market profile, and you notice, like, you could set up Fibonacci, and I might even have Fibonacci set up for this. Yeah, you know, you can set up Fibonacci for this. And one thing I always notice is Fibonacci has a tendency to line up very nicely with the lines on the market profile. But one thing with the market profile is that the markets always have a tendency to revert back to where the most time and volume has been spent, because that's where the market has found value. So, you know, it shot right to that point, right where the most time and volume has been spent, despite whatever news has been out there and everything else. So I talk about that. I even talk about how to trade the market profile. You know, for instance, you know, a trade location to get in, once it's outside and it gets a little bit stretched out down here, like you saw here, this isn't necessarily the entry of the trade, but as soon as it settles inside this area, then yeah, it wants to spike up. So I go through that. So there's a bunch of videos. You can call us and we can set you up with that, Chris, but great question. Also, do you consider toss expected move when you're setting the short leg? I don't necessarily look at the expected move, and what you're referring to here is this expected move. The volatility embedded in these options tells you that the market is expected to move within the next 28 days, $3.60, right? I don't always look at that, because when you're playing with high implied volatility, it has a tendency, I'm looking at it, to come in. So I don't really look at that all too often, but definitely is a good thing to look at, especially if you're a newer trader. It's probably even a good thing for a more experienced trader. I'm just looking at the probabilities for the most part. So if it has high implied volatility, I'm looking for that probability to come back down and try and take advantage of that. And if volatility comes down, then this number is going to get much smaller anyway. So, but yeah, you could definitely look to set that up as in regards to, all right, if we're setting this up on the 2.5s, you know, it's a plus or minus, you know, $3.50. So that kind of puts us somewhere down down here. You could kind of start playing around with that. So maybe even go to buy these, sell 2 of these. That might make it end up working out. Sell 2 of the 67.5s, and then skip the strike and buy the 15s. You're still paying a debit. Yeah, and that's partly because these bid asks are so wide, you know, so it's kind of hurting me in that regard too, but still paying a 22-cent debit. It would have to be a credit for me. All right, so Chris, you were asking about this. I don't know if you're already, I think I've seen you several times, so I'm sure you probably are part of the membership, so you should easily get access to these. And if you're having trouble still, you can call us at 310, and that goes for anybody. If you're having trouble finding any of the videos, 310-598-6677. We'll get you onto that right away. But we're doing 2 months premium membership for the price of 1. So you basically, you know, you're going to be able to get through all of these videos and more. But you get my daily market commentary videos, options with trade analysis. I go over everything. I go over the data in these things. I go over the economic data. I talk about the FOMC. Talk about the markets, talk about where I think the support and resistance are in the markets, and then I go through every single trade that I do. I tell you when I'm buying them, why I'm buying them, when I have to defend them when they're going against me. I talk about being mechanical and how to defend them, and when I take them off. So I talk about every single one of my trades. Those are not recommendations, but I'm just telling you how I'm doing it so I can teach you the process. Also, you get free access to over 50 online trading workshop videos. I think that's even increased since now. Get access to Wolfman's trading lessons. If you guys have learned anything at all from today's webinar, I mean, you guys should take advantage of this because you're going to learn a lot more. And I'm sure if you learned anything in any one of these videos, it's going to save you the price of what you paid for this premium membership. And you get the trading lesson video archives, which is a little bit of a briefer on these different option strategies. I don't go as much detail, but it's definitely great for refreshing. If you're not familiar with it, maybe even watch that before you watch the whole webinar so you kind of get your head around it before getting into it. And you know, you can watch them multiple times so that you can learn them for sure. You also get the special trading courses. So I mean, all in all, this package is a great deal. I mean, it's usually $2,000. You're getting it for $97. So great deal. If you've learned anything at all, if you're a newer trader or even a savvy trader, I'm sure you can learn something. I mean, even if you just got access to the trading hack videos. So take advantage of this. It's a great deal, especially for the next couple months. We're done with the webinars for broken wing butterflies and butterflies, so now we're going to be moving on to some other ones and be teaching you something there. So these courses will definitely pay for themselves. And they're all designed to set up, just like I went through those step processes, they're all designed and set up to increase your probability of success, and in that, designed to create consistent winners, because I talk about how to stay mechanical. Take the emotion out of it and knowing when to get in and when to get out and taking advantage of that. So you guys should all do that. The other thing is you can always reach out to us with any questions at trading@protraderstrategies.com if you're a part of this. And if they can't answer your questions, they'll send you off to me and I'll talk about it, just like with Larry. And I were going back and forth on the emails on a couple of issues that he had, you know, and ended up helping him out throughout the trade that he had on. So, you know, take advantage of all that stuff, you guys. That's about all I got for you guys. Have a great weekend. Have a great extended weekend. You got Monday off. I hope you guys all have something fun to do. And if you can't take that, take it easy. Sorry, that was a direct hit. Take care, you guys. Have a good one. Thanks, Farshed. You have a great weekend, too. I appreciate it. Thanks, James. Take care, everybody. Thanks, Chris. Hey, Chris, reach out to us. Seriously, if you're having trouble finding those, we'll take care of it. Oh, by the way, the link is in the chat window. Yeah. So click on that link. This is the link here as well. So you can just copy that down and put that in your URL. But the easiest way to do it is to go to the chat window, you guys. Take care.